emerging markets index fell 20% since its peak in September 2014, and Beijing's move to devalue its currency just a one-off or not. It certainly sparked a wide sell-off in global currencies, with emerging markets destined to feel the pinch even more. I'm Bruce Whitfield. This is the Moneymakers. Tonight, I'm speaking to a man I'm hoping is a moneymaker, Nedbank's head of strategic research, Mohammed Nalla, about making money in times of a sell-off. Or do you simply put your head in a hole and hide until it's all over, Mohammed Nalla?
No, the ostrich strategy doesn't work. Putting your head in the sand, that doesn't mean the pain's going to get any better, Bruce.
Okay, well, what do we look at? We look at emerging markets. We look at the fact that the Chinese have devalued their currency. They've devalued the yuan only fractionally, and it's like it's the end of the emerging market world.
I'm laughing. Every headline I see that says, Chinese devalue, it's currency wars. And the reason I laugh is that where have you been hiding? If you put your head in the sand for the last few years, we've had currency wars as a standing feature in global markets for the last couple of years. And the fact of the matter now is that the Chinese, it's a 2% devaluation. This is a policy tool in terms of trying to shore up Chinese competitiveness. And the worry here is that does it trigger a broader regional response? Do you get the Koreans? Do you get, every other Asian economy that's going to feel the pain of this Chinese devaluation? Do you get them rushing to the bottom? Already you're starting to see talks of Singapore saying maybe we'll let the Singaporean dollar actually weaken a little bit further as well. And this is to try and fight over what is effectively a smaller and smaller pie or piece of the global trade pie.
You see, what we've got is a very, very strong dollar. And that's, the US economy has recovered far better than anyone thought it would post 2008. The dollar has been resurgent. Other economies are struggling. Why would the Chinese devalue in this environment? What's in it for them?
Yeah, so if you look at the dollar, we say it's a strong dollar. Yes, it's a lot stronger than it was a couple of years ago. But bearing in mind, it's come a long way. So if you look at the dollar index, it's probably around the mid-90s right now in terms of index points. The dollar at its strongest, and now we're talking in the Volcker years when they hiked rates very aggressively, was as strong as 140 index points. So when I say the dollar's got scope to go, we could easily see that go another 20% or so. That's a strong dollar. What we have now is the start of a strong dollar, and it's on the, I guess it's on some speculation that the US Federal Reserve is going to hike rates fairly aggressively and continue doing so. That for me is not likely. And ironically, the Chinese yuan has actually gradually, over a period of time, they've let it drift stronger and stronger and stronger. That was quite a smart move because they've just built some room in there as another policy tool so that when they need to defend that 7% target on their growth side, and I think they're worried about their trade numbers, they've got monetary policy, they've got reserves they can throw at it, and now they've got currency devaluation as well.
And they also, it's only a tweaking. I remember John Major devaluing the British pound in the 90s by about 10% overnight. Surprised the markets completely. It was just a case of one day they were trading at X and the next day they were trading at Y. That was it. The Chinese do what they do. They trickle. They trickle as they need.
It's trickling along. Like I said, it's a 2% devaluation. I think it's getting way too much press time internationally, and it's because the Chinese are doing it. The Americans devalued that dollar. If you go from 1970 to where we are right now, look at the devaluations that's crept into the US dollar. That's a currency war if you're looking for one. The fact of the matter is that the Chinese have to defend that 7% growth target. It's the world's second largest economy, and they've got massive imbalances. So perhaps they're saying, if we tweak monetary policy to try and keep that growth lever going, maybe it's going to fuel some of those imbalances. Let's rather focus on what we're good at. We're good at trade. We're good at exporting stuff. Let's just make those exports really cheap.
But have they succeeded in doing so? A 2% devaluation feels minuscule. If you look at it in terms of the volume of trade that China does, it's significant. But it's not something that's going to get me suddenly, I must go and buy myself a Chinese meal or or go to the China mall and buy myself something cheap and cheerful.
Look, perhaps the Chinese are putting it on the table as a means of saying, hey, look, you asked us for policy liberalization. That's what we're giving you. We're trying to open up capital markets, less capital controls. But it's an odd thing because, on the one hand, they're doing that. On the other hand, they're directly intervening in their equity market. So, one struggles to really see the much bigger picture.
So how much trouble are they in? That's the real concern here. Is actually, one looked at the response of the gold price going from under $1,100 to well over $1,100 an ounce in an instant as this devaluation news broke and sticking above that $1,100 an ounce level. That suggests that there is an element of the market, a part of the market, that thinks actually China's in more trouble than it's letting on, and it's beginning to take desperate measures by Chinese standards, supporting equity markets, devaluing the currency.
Yes, I'll tell you what's got me very concerned is that you've had a quick succession of a multitude of policy tools to try and shore up the Chinese economy, and that concerns me. I mean, we don't really know, simply because can you really trust the official statistics? A lot of people I've been speaking to that go and dig into the grassroots data that comes out of China from the bottom up and build up their own data sets, they're very concerned around China. They're saying that there are massive bubbles in terms of the credit market, in terms of the property market. We know of the overhangs with regards to commodities specifically, and that has specific relevance to us here in South Africa. Yeah. And so, I mean, something's come across the wires where guys are saying maybe the Chinese are now also going to lean on the steel market. You know, they've got the capacity to do so. So right now, I think, given the quick succession of different policy measures from the Chinese, perhaps where there's smoke, there's fire. Perhaps it's a little worse than the official numbers later on.
That's the concern. However, they continue to import lots of oil. They're continuing to import at much cheaper prices lots of iron ore. There is still, either they're stockpiling stuff, or there is industrial demand for raw material.
Now, if you look at inventory levels on a lot of your base metals, inventory levels have generally, and it's not across the board, one or two have actually run off, but inventory levels in general have actually ticked a lot higher in China. So they're bringing the stuff in, they're stockpiling the stuff, and potentially it's for further value add down the line, where they can then go with a finished product. You bring in iron ore, you produce steel, and then you go and you destroy global steel markets. Not to suggest that they're doing that, but they have the scale to do that. They've done it with manufactured goods. I mean, everyone has something that's from China. And potentially they're just looking at different parts of the value chain that they believe they should capitalize on.
Okay, so how does it affect us ultimately? Because here we sit, bottom end of Africa, our currency is going to hell in a handbasket, weakest level since 2001. We've seen it plumb those sorts of depths recently. We are under a lot of pressure in terms of just our ability to sustain a currency in a quite a strong inflationary environment. It's a little bit concerning. Rates are going up. They will continue to go up, despite the fact that we've got low growth. President in denial over some of the data that is coming out. How does this affect us?
I'm glad you bring in inflation, because ironically, the Chinese devaluing perhaps is as a response to their fears around deflation. Okay. So in South Africa, we import a lot of that inflation because of the weaker rand. Unfortunately, when you get a move like this, there's a general sense of unease across emerging markets. And South Africa is a high beta destination, so our rand tends to really blow out quite considerably. And I would argue it's held its own reasonably well. And people laugh at me when I say this, but if you look at when you look at the rand relative to other emerging market currencies over the course of the last 12 months, we haven't been the worst hit. I mean, you've got Brazil in there, you've got Russia and so forth. The fact of the matter is that when the pain comes for emerging markets, whether it's China, whether it's the Fed, these are not the causes of an emerging market crisis. They're just the catalyst. And it's the catalyst because emerging markets haven't done the right things for too long. They haven't put in place the right structural reforms. We unfortunately can't even capitalize on the significantly weaker rand adequately. So whilst our current account deficit might narrow a little bit, we're not even close to maximizing the benefit that this weak currency could have brought this economy.
I just remember, I forget her name now, but she was the COSATU chief economist many years ago, and then she went and worked in government, surprisingly enough, but arguing very, very strongly for this weak currency. And I just wish she would raise her head above the parapet now so we could have a chat. The weak currency is destructive and is damaging the South African economy from an inflation perspective.
Weak currencies can work for you. Look at the chart.
It's not for us.
It's not for us, exactly. Yeah. It worked for the Koreans. It could possibly work for the Chinese because they've put in place all the building blocks to have an export-led growth model, to have an export engine. We've got rigidities in our labor market. We've got energy constraints. I mean, I'm not going to go through the litany of domestic structural issues that we've got here, but unfortunately, the ones that we do have, the subset we do have, do not predispose us to actually capitalizing on a competitive devaluation. And South Africa ironically gets this by default. We're not putting in place any of this. We hike rates 25 basis points and the rand still blows out. It's because we don't have the building blocks in place to capitalize on a weaker
Do you see any potential for those building blocks being put in place, or is it just more of the same coming out of National Treasury, very good at what it does, but it's a small island in a sea of sort of, I suppose, terminal decrepitude in government departments?
I mean, Bruce, the fact of the matter is that you're going to get, like you say, it's like little islands. Even within the policy framework, you're going to get little islands of excellence. But unfortunately, until you get all of these little bits and pieces talking to one another and working as a cohesive whole. And we don't have that, unfortunately. Until you get that, it's very difficult to make a compelling investment case for South Africa Inc.
Yeah, I mean, the president standing up and making his comments on the economy, saying, you know, it's not so bad. Everybody's putting far too gloomy a pall over the South African economy.
What's your frame of reference, Bruce? I mean, I sum up South Africa in that one sentence, is that it's not as bad as people have you believe, but it's not as good as it could be.
Yeah.
Is that we've been this muddle through type of economy. No, well, I say the lights are not going to go off, but they might for a short period of time. It's not going to fall in a heap, but unfortunately, this is a competitive global capital market, and capital flows like water. It goes to the path of least resistance. And unfortunately, we're not that path right now.
Do we understand that we need to become that path? In your dealings with people within government and your dealings within people, with people in the state?
Again, Bruce, there are pockets of excellence within National Treasury, within the Reserve Bank, and we need those pockets of excellence to start permeating the broader, I guess, political spectrum. Are we there yet? No. Do you get there quickly? Probably not. So unfortunately, that means you're gonna languish through this pain for a little bit longer than you arguably should.
Your forecast for a dollar that could go 20% stronger, what happens then?
Yes, unfortunately, I mean, we fixate on the dollar rand, and that's where a lot of the pain has come through. On a trade-weighted basis, it hasn't been terrible, but very recently we've lost ground. I mean, with the pound, it's just gone north of 20, and it's there and thereabouts right now. Slowly, you start to lose ground, and unfortunately, I find myself saying, well, our best case scenario has gone from being like 10 Rand 50 to 11 Rand 50, and you keep ratcheting those up. It's not like 12 Rand 50.
You'd be like, yes, be like Brian Molefe, move the goalposts. Our new timetable for Kusile Mudupi is this. Yes.
I will tell you something. Where I had anticipated the rand to get weaker because of inflation differentials and yield differentials and all of these terrible things, but that are in place with us. I didn't anticipate it happening as soon as it has right now. It does tend to be fairly cyclical. It's at about one standard deviation away, and so it could possibly extend to north of 13 Rand against the US dollar. Then maybe some reprieve, but with a caveat, it's a reprieve. It doesn't change the longer term direction. It
doesn't, but also you look, and history is no teacher of the, it is a teacher for the future, but when one looks at the graphs and one shows the blowouts in the currency and the pullbacks in the currency, one looks at the commodity strength that has underpinned those pullbacks. Is it as simple as hoping for a Chinese burst of growth that will see commodity demand pick up and therefore the currency strengthen again?
Unfortunately not this time. So we've gone through the honeymoon phase already. If you get a burst of Chinese growth, as I mentioned to you earlier, you've got these massive inventory builds in a lot of the resource, specifically base metals markets, that effectively mean that even if Chinese growth continues to pump, we're not necessarily going to see that uptick in terms of resource prices, in terms of export performance. So
next time you come,
batten down the hatches.
Next time you come, bring a happy story. It's bedtime. People need happy stories.
What questions you ask, Bruce?
Nedbank's head of strategic research, the insightful Mohammed Nalla, joining us this evening on the Moneymakers with Bruce Whitfield. We'll find other ways of destroying your soul and hopefully helping you make better decisions on how to make your money tomorrow. Until then, it's good night, if you can sleep.